Hi everyone. For those that don't know me, I'm Glenn Beale from Campbell Tyson, so we're really pleased to be able to present this seminar to you today. One of the challenges we as accountants have is getting farmers to think of their farming activities as a business. And we need them to consider things like what is best practice. We need them to benchmark themselves against other farmers. We need them to think about tax planning, succession planning. In fact, it'd be quite nice if farmers had a business plan at all. And a lot of them don't. So I'd like to congratulate all of you for being here today, because you're in that elite group of people who do think of your farming activities as a business and are trying to improve. So well done.
Okay, in terms of tax, there's a huge amount of flexibility and efficiency that we can gain through using a company structure. So profits generated within a company can either be taxed at the company tax rate, or they can be distributed to the shareholders and taxed at individual tax rates. So that gives us a huge amount of flexibility. We can spread profits around to the people who have the lowest tax rates and get the least amount of tax across your group. Historically in New Zealand, the top individual tax rate has always been 5 to 6% higher than the company tax rate. A company also provides the ability to deduct some extra costs that partnerships or sole traders can't. So for instance, 100% of expenses relating to vehicles can be claimed under a company structure. You don't have to keep log books or do percentage claims. What we do at end of year is an adjustment journal to take care of the need to account for fringe benefit tax. Okay, moving on to a trust. Trusts are really in New Zealand about protecting assets, but there are some other advantages of using a trust in your structure as well. By separating the ownership of these assets into a trust, it means that physically, personally, you don't own those assets anymore. And so they're protected from creditors in the case of creditor claims or legal action, in the event of relationship property disputes. They're protected for your children's education, and also if you ever wanted to apply for government subsidies that are asset tested, you physically don't own the assets, your trust does, so you might qualify for subsidies that you might not otherwise. By utilising a trust and company structure, assets are protected for the current and future generations, and significant cash savings can be made by increasing the deductibility of expenses and reducing the tax paid by moving profits around. Quite interesting findings. Basically, the couple trading under a company trust structure would have paid about $90,000 less tax over the 10 years, and that's from 2003 to 2012, than the company trading under a partnership. So I guess the question that I'd like to ask you all is, what else might have you done with $90,000 instead of paying it to the IRD? Okay, so I'd say it's fairly fair to say that no one likes paying tax in any form, whether that's income tax, GST or user taxes. And putting my accountant hat on, there's nothing I like more than taking a client's tax bill and looking at all the different ways I can possibly think of to bring it down to as little as possible. Significant tax savings can be made in a variety of ways, and usually just require some planning and some education and information. And while I never like to encourage people to spend money to save tax, I do like taking expenditure that you're already incurring in your business and making it tax deductible business expenditure and reducing what you have to pay to the IRD at the end of the year. So there's three main areas that we see regularly being underclaimed or not claimed at all, and these are entertainment, travelling and home office. So most people who are self-employed genuinely live and breathe their business. They very rarely go anywhere and they're not talking about what they do on their farm, and that includes when you're going out for dinner, when you're going to the pub, or even when you're watching a rugby game, which means that all of these things should be claimed for tax. So did anyone here contemplate the fact that if you bought Rugby World Cup tickets, you could have claimed them for a tax deduction? Included in your seminar packs today, I have put some business entertainment tables which outline all the different types of entertainment you can be claiming through your business. And I'm sure that the next round of drinks you share at the pub might taste that much better knowing that the IRD is subsidising part of it. So the claiming of travelling both within New Zealand and overseas is an area that most people don't gain the full advantage of within their business. So having a chat to your accountant before you go away anywhere and put some plans in place about the types of things you might be able to do to link back to your business might mean that some or all of your travelling costs become tax deductible. So fitting in a farm visit, a trade show or some specialty store visits might be the difference in the eyes of the IRD between what could be a private trip and what could be a business trip. The example that we often use is we've got a client who owns a couple of cafes. They did, I think, a 5 or 6 week trip around Europe. visited a cafe every morning and every afternoon, and 100% of their trip was tax deductible. Now, just in terms of home office, most farmers conduct part of the day-to-day running of their business from home, which means that their heating, lighting, rates, insurance, mortgage interest, repairs and telephone can at least in part be claimed as a deduction for tax. The amount that can be claimed will depend on your structure and also the amount of your home that's being used. But again, it's a legitimate tax deduction that a lot of people aren't utilising, and I have again included some information in your packs today about home office claims. The timing of today's seminar isn't accidental. For most of you, May is the final year in your financial year. And as such provides the perfect opportunity to make some adjustments that can bring your end of year tax down. So I've put a detailed checklist of these processes in your seminar pack, but include really simple things like ordering fertiliser, going through your fixed asset list and noting anything that's been scrapped or obsolete, writing off bad debts or accruing holiday pay. Most of these things don't take long to do, but they can make a huge difference in what you are paying to the IRD for tax. At Campbell Tyson, we believe that having a fresh set of accountant eyes look over your financial statements and your tax bill can provide really good opportunities for improvement and tax reduction. And as a group of partners, there's 5 of us at Campbell Tyson, we regularly do a peer review of each other's work just to make sure that what we're doing is, fresh and in the client's best interests. So what we've done is actually put together a voucher, and it's in your seminar pack. It looks a bit like that. And what it is it's a free 1-hour consultation with a Campbell Tyson director just to look over your financial statements, see what opportunities we might come up with, and hopefully highlight some weaknesses or some opportunities within your business. Because the IRD are really quick to charge interest or penalties when you haven't paid enough tax, and don't pay you much interest when you've paid too much tax. So getting it right is really important. So cash flow and profit projections are really important. They should be prepared annually and then monitored throughout the year against your actual performance. Because understanding when you're likely to have high cash requirements and talking to your bank before you need it usually means you end up with a better relationship with your bank. So we're helping more and more of our clients utilise the ability of Xero. Xero is an internet-based accounting system. It downloads your bank transactions for you every night. So because it's doing your data entry effectively for you, you can't have manual data entry errors like transposed figures and things like that. Being internet based, it means you've got access to it anytime from anywhere, that there's an internet connection, and your accountant or your banker, if you want them to and allow them to, can log in to review your performance and position. Particularly for accountant, this is really important because it means they can support you. They can give you better advice, basically around the clock. So we currently have 300 clients in a variety of industries using Xero, and we can help with setup, training, or support as you need it. Again, there's some information in your packs about Xero, so it is becoming a really, really popular product. While many of you here probably undertake a lot of your accounting processes yourself, doing things like cash flows or GST returns, we know that it can be quite a headache, and in actual fact, sitting up till midnight on the 28th of the month furiously coding your bank statements to get your GST return to the IRD on time isn't much fun. But as accountants, we love doing that sort of thing. Over the last couple of months, we've developed some all-inclusive accounting packages, and at the moment only tailored directly at dairy farming clients. So what we've put together are packages for a monthly fee. You can have your accounting software, your data processing, GST and tax returns, financial statements, dairy-based benchmarking, and your IRD and ACC requirements all taken care of. And then depending on your business structure type, we can also provide you with regular management reports, do an annual cash flow projection, and meet with you at your place. So there's 4 different versions of these accounting packages tailored towards different business structure types and sizes. Information about 2 of them are on the back of the financial statement voucher, just talking about the different things that we offer. All of them can be tailored to what you need, but seem to be, what people are wanting in terms of breaking down that cost, paying for things monthly and having a much closer relationship with your accountant. As discussed by Glendon from the National Bank earlier this morning, planning for succession is one of the key issues facing a large part of New Zealand's dairy farming sector. So succession planning done well follows a carefully considered and clearly set out plan that ensures that everyone is treated fairly. Equally, succession planning done less well can be expensive, it can be stressful, upsetting, and ultimately cause family disputes which may never be resolved. So at Campbell Tyson, we've put together a relatively simple, as simple as succession planning can be, simple 3-step succession planning process with our clients. So the process basically looks like this. At the outset, you want to consider, through your succession plan, what you're trying to achieve. At the end of it, what does the picture look like? If there's enough assets to go around, then everyone can be treated equally. But if there's not, then a whole lot more wealth and assets need to be grown while you're still alive. Then the first step is to get the structure right, and that usually involves a combination of trusts or companies, or both. The right structure provides flexibility. It assists with a gradual or a complete succession process. It ensures the succession plan can be enacted whether you're here or whether you're gone, and it can achieve things along the way like reducing the tax that you pay. The second step is to transfer the income generating assets to the successor, and this usually includes things like the herd and plant. So what this does is allows the successor to have some control over their destiny. It provides them with the incentive to maximise the income generated, and they're earning in their own right instead of receiving handouts, which tends to reduce family tension and issues. The way we see it is really having your successor as an employee on your farm for their entire lives is never going to give them the capital they need to purchase the farm. So then the third step, as a family group, it's about generating enough wealth and enough income so that at the end there is enough to go around. So the idea is to maximise your profits, to make your assets work really, really hard to generate as much income as possible for you, and to diversify your investments so that you've got a mixture of on-farm assets and off-farm assets. Fair can be quite different to equal. All of your beneficiaries don't need to receive exactly the same inheritance at exactly the same time, because the reality is that your children have different requirements at different times in their lives. So helping your daughter purchase her first home or your son purchase a business can be done quite separately to helping another child purchase their first herd. So again, reiterating what Glendon spoke about this morning, in any succession planning process, it's really important to communicate with all of the parties involved, whether they're involved in the day-to-day running of the farm or not. Open communication about what you want to achieve through your succession plan means that there's much less likely to be family members falling out later on, which tends to be what we want to avoid.